No video yesterday, and luckily so, because we saw a bounce and we gave it all back today and then some. And that leads us to the thesis of today's video. And hopefully we can come up with a solid plan that can continue to produce results over a longer period of time. And we don't need to second guess it when we get a single day's move and have some weird things going on. And we can stick to this plan and get through any sort of economic environment, stick to the fundamentals we choose. So the title of this video today is Fundamentals, Not Mirage. Yesterday was a mirage. There was green everywhere. People were saying, oh, the bottom must be in. Damn, we've had a tremendous decline. I heard somebody today talk about generational buying opportunity. Let's analyze that generational buying opportunity. What is a generational buying opportunity? A generational buying opportunity is when stocks are at tremendous lows, historical lows, generational lows, and they make sense to buy for a generation. Some very long period of time, and it's gonna make you rich. Guess what? Right now is not a generational buying opportunity, at least in my opinion. Why do I say that? I say that because Apple is still at a 23 times forward earnings multiple, not even at its lows of the year, and its multiple, for some reason, is above its historical level. Above its historical level, well, historically, iPhone sales have been growing tremendously. They've been doing tremendously well. Right before COVID started, right towards the end of 2019, we started getting data that iPhone upgrade cycles were lengthening and the iPhone growth was slowing. That was all lost during COVID. Everyone went home, everyone started upgrading their technology products, and they experienced a boom. Well, guess what? Now we're entering back into normal times. And Apple is taking down their production targets. They're taking down their production targets. Just a few weeks after launch, they're editing their production downward. Sounds a whole like that 2019 situation. And for companies to have above average multiples, they need to have above average growth rates. It sounds like Apple isn't necessarily going to have an above average growth rate. It's certainly not going to have its own above average growth rate, which had given it an average PE of somewhere around 15 trailing PE. Right now it's at a 22 forward PE. Think about that. So in my opinion, Apple has plenty to correct. I think this theme is prevalent around the rest of the market because earnings are coming down. They haven't come yet in expectations, but they're going to come down in reality. That's just what's going to happen in this economic environment. It's starting to happen in some areas. It's not going to stop because the Fed is raising interest rates and they're keeping them there. We're just now touching 4% on the 10-year. We haven't been there all this year, yet we've still been in a recession. And rates have a lagging impact. You raise the interest rates, okay, cost me a little bit more to borrow. Now I might not borrow as much money. Now that I haven't borrowed as much money, my future spending might not be as high. Now that my future spending isn't as high, earnings go down. Now that earnings go down, these companies don't need so many employees. They can't have so many employees. So they fire some employees. You get the idea here? You get the cycle? You see how it works? It's not over, okay? We're not in generational buying opportunity yet. It's better than it was at the all-time highs. It's better than that, I guess. But we still have more to go. How much more to go remains to be seen. I'm not trying to say, while I'm being somewhat gloomy and doomy, I'm not trying to say that the Great Depression is upon us. I think a run-of-the-mill recession is upon us. Interest rates at 4.5%. They're tighter, but they're not tremendously restrictive. It's not that it's impossible to borrow money. It's not that the case to borrow money is non-existent. It's just less enticing than when the 10 years at 0.5%. when it's at 4% or 4.5%, which is where it might end up. So stocks have a little bit more to go, just given where yields are. Additionally, they have a little bit more than that to go based on earnings revisions. So generational buying opportunity, I think that's taken off the table. You have to get a whole lot of things right to say this is a generational buying opportunity, which I'm looking for. I will pounce on when it comes, and I'm sure you're looking for too, but it's not here yet. We have barely even seen earnings revisions get revised, and you want to buy companies when they're at their lowest. Right now, they've got essentially peak earnings expectations. So that needs to be revised. And that will be revised once economic headwinds become more obvious, possibly when another increase in oil prices comes along, that eats into consumers' budgets, these kinds of things occur, then maybe analysts will begin revising their earnings expectations down because they haven't done so yet. We're looking for that generational buying opportunity. It's not there. It's not there yet. There's a whole bunch of reasons, as we discussed, that it's going to come in the future and in the somewhat distant future. So the point here is, don't be shaken by the mirage. Don't fall for the mirage. We're in a bear market. We're in a dry Egyptian desert. It's not water. It's a dry Egyptian desert. You just gotta realize that and keep walking to the real land. That's what it's about. Don't veer course just because the mirage is telling you there's water. There's not water. But that doesn't mean there aren't stocks we can buy. We can definitely buy oil. There's a number of reasons for this. Oil demand does pull back in a recession, and oil prices typically fall 30 to 40% in a recession. We've done that. Check. The thing with this recession and this oil situation is that unlike past oil booms or economic booms right before a recession, oil companies are aggressively drilling and drilling and drilling. They're increasing supply because prices are going up. The world can't get enough oil. It just wants to grow. Now, most recently, energy companies have not done that. They have not invested aggressively in energy production. They've been very hesitant to do so, even when oil was above $100 a barrel. We've had a big decline here because paper markets and traders are fearful and drawing the correlation that, and computers, even computers are probably doing this. Recession equals lower prices in oil, sell oil, okay? This situation is different. I know the devil phrase that nobody wants to mention is it's different this time. Well, it actually is different this time in oil. We have done unprecedented releases from the Strategic Midterm Reserve. And guess what's coming up not too long from now? The midterms. We'll see what kind of impact that has. We're currently in the most intense phase of the Strategic Midterm Reserve. And I think it's no surprise that we're at virtually year-to-date lows in the price of oil, as we're on some days unloading 10 million barrels of oil onto the market. That has happened, okay? 10 million barrels. I think it was last week, we had a 9 and 10 million barrel day of oil sold into the market. You know what the worldwide consumption is of oil per day? It's like 92 million barrels of oil per day. So to get 9 and then 10 million barrels in a single day, obviously it's gonna have an impact on price. But you know what OPEC is gonna discuss next week? The possibility of production cuts. It seems like an area to buy stocks in. If you can be patient, collect the dividend, and see what happens. Ultimately, that's what this time calls for. A lot of patience. Don't jump at the first sign of green. Don't feel any FOMO. No fear of missing out, okay? Just stay calm. Just stay patient. Know the plan. Stick to the plan. And we'll see what happens on the other side of that generational buying opportunity. So that's today's video. And until next time, peace out. Finally, programming note, no video tomorrow, no video on Monday. Peace out.